Hi, and welcome to Jankin's Code on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're going to have a look at a concept called risk capacity and learn how this can enrich our analysis of enterprise risk. And for more on risk capacity, please consult my book, Empowered Enterprise Risk Management, co-authored with Petty Capstad. There's also more information on my webpage, riskbudgeting.se, and as they say here on YouTube, please like and subscribe. So whenever you hear the term risk capacity, it's most likely going to be benchmarked or compared with another term, risk appetite, which is going to be understood as capturing the willingness of a firm to take risk. Whereas risk capacity then would rather be about the firm's ability to take risk. And how they relate to each other, you know, here you have a picture from the COSO document on enterprise risk management, where it's illustrated that you have a certain risk capacity, a hard limit over here, and you have your willingness to take risk here, which should be comfortably below, preferably, so as not to exceed your risk capacity. And then your actual risk profile here, which you manage, is then you're going to select something close to your risk appetite. Then that will be the general idea, so that whenever your risk appetite is actually above your risk capacity, now that's pretty reckless, probably, because you don't really have the capacity to go there. If you still do, it means you're out on a limb here, and we can only hope that things work out. Whereas if you're below this line here, indicating risk capacity, well, then you are within your limits, but you're also possibly too conservative. It could be a case of unused risk capacity that could be put to more constructive uses, right, and generate better returns. So you don't want to fall too far below your risk capacity either, because that means your capital is idle and not carrying good risks. So risk capacity, if we take the sort of bigger picture view here, is related to yet another term, risk capital, which is sort of loosely referred to as the amount of capital you need to support your business, your risk taking, because any business is going to be risky, right? You're going to have to live with that risk and to deal with what comes your way, the shocks and the shortfalls of performance, etc. You're going to have some capital as a buffer against that sort of risk. So this is the very old idea of having some sort of a buffer against risk, against variability in future performance. You want to have some built-in slack, right, to deal with those things, so that you can claim that you have a reasonable shot at not only surviving but also thriving in worse than expected scenarios, because we're going to analyze scenarios that deviate from the plan, the forecast. So the question is, what happens then? Are we going to have enough buffers to deal with these worse than expected outcomes and keep executing the strategy? And risk capital really has two practical sort of approaches. One being economic capital, which you hear a lot about in this setting of banks and financial institutions. It's very much related to the survival of these institutions. You have to have enough capital to survive these extreme events and remain solvent, because these institutions are systematically important. So survival becomes a matter of great importance, and not only banks but the regulators and the rest of society, we all have a stake in that. So it's economic capital is supposed to make sure that you can go through some kind of worst case scenario and still survive. Whereas risk capacity is more geared towards executing your strategy to create value. So you want to buffer against that as well, have some resources in place that allow you to keep executing the value creating strategy. regardless of which scenario you end up in. So it's not limited to survival, even though that is going to be part of the picture as well. So it is fundamentally a liquidity concept. Do you have enough liquidity around to take care of your ongoing payments and stay afloat? So whereas economic capital targets survival in the worst case scenario fairly narrowly and explicitly, risk capacity deals with the execution of strategy across a large number of worse than expected scenarios, including then the worst case so-called scenario. All right, so all right, so we're talking about value creation here. We have a set of strategies and investments in place, and we want them to perform well or even optimally in all scenarios. And we're talking not just the expected one anymore, you know, the one we have in our budget or the strategic plan or whatever. But the fundamental observation here is that strategy execution is really conditional financial health. You can't be a formidable competitor and execute your expansion plans, etc., if you're lacking funds to do so. And even the suspicion of possibly lacking financial resources could be enough to impair your strategy if people start avoiding you because you've become too much of a risk. So strategy performance is definitely a function of financial health in many cases. So in these worse than expected scenarios, will you then be able to continue to implement your strategy and pursue your value creating investment opportunities, or will you be forced to cut back and be very defensive? Now that is where risk capacity can make a difference between those two. It allows you to not only function and deal with your ongoing payments and that sort of thing, but you're also perhaps in a position of strength. So that is the strategic dimension of risk capacity, of which we will have more to say. But okay, we're ready for a definition now, I think. Intuitively, risk capacity is a cash buffer. So it's not a buffer of equity capital. It's more a buffer in terms of cash available, cash at hand. So you can think of it as the cash buffer you need to make it so that you can invest optimally, even in a worst case scenario. All right, so you're talking about enough liquid resources to take you through one of these worst case scenarios. And all right, whereas more formally, you could perhaps define it as the conditional cash that you need to maintain your value creating cash commitments with a targeted probability. So a few more elements here to this definition, but we focus here on the value creating cash commitments. We're in the business of creating value, right? And we're going to accept a certain probability that we may not be able to execute all that. But you need some cash or conditional cash to make sure that this targeted probability obtains. Also, somewhat formally, it's the conditional cash consistent with an X% probability of falling short of cash commitments. So we have now expanded our definition here of what's cash or what's the buffer to not only be cash at hand, but also conditional cash. We're going to explore what we mean by that. But first, let's try to explain what we're talking about here, what risk capacity is doing. So you have your operating performance here in terms of a cash flow distribution. So it's we have a plan, we expect a certain outcome, but we know that there's going to be variability in this performance measure, right? So question is, what happens then in the tail of this distribution? Is that going to lead to certain consequences in terms of not being able to execute the strategy? Well, let's say that cash commitments here is given by this line, and that is what you need to execute your strategy. You need a certain and meet your ongoing debt payments, etc. This much is required to do that, to sort of optimally keep going with all of those activities. All right, so already here we start having some kind of an issue, right? Because cash flow could fall below that level, so there's a gap. And risk capacity is what fills that gap. So it will absorb essentially any shortfall relative to these cash commitments. And it will do so for some period of time or for some distance here, until risk capacity is exhausted, and you have to accept that if that happens in the real, far out tail here distribution, you won't be able to keep up your investment. You will have to scale back. So we could interpret this outcome as a underinvestment, and this probability here as 4%. So whatever is here in the tail adds up to 4% of the probability mass here. So risk capacity, if you had zero risk capacity, the probability would obviously be much, much higher. It would start already here and sort of. So risk capacity has the benefit of reducing tail risk and absorb these cash flow losses, cash flow shortfalls rather. All right, so these cash commitments come in two forms. You have the fixed variety related to debt and its equivalents. So things like interest expenses and installments on debt, these are fairly hard sort of thresholds, in terms of having money available to service those commitments. Otherwise, you would possibly be sent into administration, right? And you would face some legal consequences of those defaults. So whereas discretionary cash commitments, while that may be or may sound like a contradiction of sorts, you could possibly defer capital expenditure and sort of not execute it here and now, but we're going to be interested in actually sticking to the plan here as long as we think that it's value creating. So we're committed to it in the sense of wanting to do it because we believe in these projects and we want to get them going and start creating value. So we have a commitment to them even though it's not a legal one. So and if you fail to reach the level of performance and risk capacity where you cannot uphold these discretionary cash commitments, we're talking about underinvestment then, because that would typically be the first commitment you would scale back on, because there you have the most flexibility and the lowest cost. But still, there is a cost because you're no longer following through on your business plan here, and your strategy falls short of expectations. So the whole idea with risk capacity is to help us avoid those kind of negative consequences by absorbing these cash flow shortfalls. So it's liquidity available when you need them to cover up and absorb these shortfalls. And shortfalls then are given by the difference between cash commitments and operating cash flows. Whenever operating cash flows are sufficient, there is no shortfall and it takes on the value 0. And we've said that we've expanded the definition here of what's cash to include conditional sources of liquidity. So that there may be financial resources available to us, except that we're not keeping them on the balance sheet in form of cash at the moment. So what if you could reasonably expect to have liquidity available in one or more of these scenarios where a shortfall is happening? Well, then that's a valuable financial resource that will add to your risk capacity because you can count on it being available. It's just that you haven't sort of gone there and utilized that option as of yet. So the one requirement here is that these financial resources to count towards risk capacity is that they are sure to be available to us in these worse than expected scenarios. There has to be basically no question that we can access them on reasonable terms and at acceptable costs, so we can count on them. That makes it risk capacity. So we have to make sure that there's a check on that, and otherwise we're talking about negative. You can always, or not always, but you could possibly get new money, but what if the cost is exorbitant, right? I mean, you wouldn't think of that as a convenient sort of solution. It would be a negative consequence. You would consider yourself in trouble, and it cannot be risk capacity then, because it's supposed to keep you out of trouble, so to speak. So it has 3 elements then. excess cash and equivalents, for sure. That's one kind of buffer. If you know that you can access debt markets and borrow more money at reasonable terms at acceptable cost, then that too will be a source of liquidity that you can use to carry over your business plan or your strategy through one of these shortfall episodes. And we're going to count derivative cash flows here as part of risk capacity. Now that's a matter of semantics, you might say, whether derivative cash flows are part of operations or not. I mean, some managers think of hedges as something that protects revenue, and they even account for it that way. They show it as part of revenue. That's fine. I mean, but for this analysis, we're going to think of derivatives as part of the mix of assets and liabilities that help support the firm's operations, alongside debt and its equivalent rights. Is a balance sheet thing here, and it can add to risk capacity. So it's just a matter of perspectives, but that is the preferred one given the close links between the balance sheet and the derivatives. So these two are conditional sources of cash. They are possibly available to us then when there's a shortfall. Whereas this is already, it's already sitting there and we can, verify it. But these two have to be analyzed and sort of verified to the extent possible that they really will be there for us. So here's a simple example where we have some 50 million in excess cash and similar securities, and there's a credit facility, and we've assessed that there's no clause that the bank can use here to claw it back or pull back from their promises here. So they're committed to it. The bank is committed. We have that on fairly solid paper here, and so that adds another 150 million to risk capacity. Then we have created a financial derivative that if a cash flow shortfall happens, it pays off 25 million in this case. Since this is designed to kick in or yield a payoff when cash commitments are higher than operating cash flow, then it counts towards risk capacity. And we can sum them up in this case. It's rarely this simple because the spare borrowing capacity, there's more to it than just a credit facility, and derivatives are usually more dynamic, the payoffs, rather than just this one lump sum if this condition is met. But for now, if you were able to do something like that, then yes, your risk capacity is quantifiable along these terms. This is the maximum size of the cash flow shortfall, that you could absorb with this risk capacity. So not normally computable like that. Rather, you have a configuration of these things, these financial resources, and put together, they imply a certain probability of not meeting cash commitments. So you would set up a model or something like that to keep track of the fraction of scenarios in which these resources are insufficient. And that gives you, the probability associated with your risk capacity. And we're talking about two sets of probabilities here. You have the probability of underinvestment when your discretionary commitments are not reached or you don't manage to uphold those. Probability of financial distress is when your fixed commitments are in danger or being, you don't have the resources to support those. So these are measures of risk that we can include in our formal analysis here, and they will be a function of risk capacity then. The more risk capacity you have, the lower those probabilities will be. So here we set up, we will show in other tutorials exactly how to do this. But for now, you have the operating cash flow and your two sets of commitments here. You compare those and there's a surplus here. So there is no shortfall. A shortfall is when the sum of these commitments is larger than operating cash flow. So that's fine, but of course we're gonna run many different scenarios of cash flow later. So it could easily end up negative then. So risk capacity will then be formally recognized and sort of incorporated into our decision support tool. You have the excess cash on the balance sheet, observable, given that you assume what is excess cash. That's you always need some amount of cash around to function, right? So you can't deplete your cash balance. But whatever is excess cash and you could safely use up, that will be excess cash and part of risk capacity. Then you can, you register your derivative cash inflow here in those scenarios in which that happens. Whatever the criteria are or the conditions in that derivative contract. And you can draw down on your credit facility when need be. So these two here will only show numbers when a shortfall has already occurred, because they're conditional on that. You're not interested in them otherwise. So they are going to, return a zero in most cases, unless you're exploring a very bad scenario, and then your model will indicate numbers there. But we have to program these conditions and the limits, the extent to which we can expect them to be available. So let's say here we have some scenarios for operating cash flow now. And each outcome here is associated with certain probability. And you are comparing then that with your threshold here as given by cash commitments, interest payments plus capex. And in two of these scenarios, the bad one and the very bad one, there will be shortfalls. So the question is your risk capacity going to be able to absorb this or not? So let's see what happens here. You have designed a derivative to give you 25 million in conditional on falling below your cash commitments, which happens in these two scenarios. So yes, we're going to cash in on that, and that is helpful. So that there's, that takes care of part of the shortfall. But in this case, another 25 is needed to close the gap, because you have a shortfall of 50. The derivative covers half of that, and you use your credit facility. Sorry, you draw down on your cash first. But that takes care of it. You have enough cash to do so. You had 50 in excess cash, and you would then need to draw on 25 of those. In the very bad scenario, on the other hand, there's a much larger shortfall. So you, of course, can count on your derivative cash flow to pay off, helping you somewhat. You draw down your excess cash completely, but that's still not enough. You're still way, short of covering all this. So you go to the bank and say, look, we need to draw on our facility here, whatever is left, and that's 150, right? So we're finding that still we're not able to close the gap. So the risk capacity is insufficient to handle the very bad scenario. So these three elements of risk capacity are lined up here, and we can get informed about the extent to which we are, we have the capacity to support value creating cash commitments. So there's going to be an actual shortfall here, and presumably that will be capex, right? That's where you start cutting. But that's underinvestment, and that's something we would have preferred not to have to do. And we will think of that as a risk, a negative consequence of variability in performance. So in scenario 4, the bad one, the shortfall is absorbed. We have enough risk capacity, so there's no underinvestment. In scenario 5, it's not absorbed. We don't have enough, so there's going to be underinvestment. And since we know the probability of this outcome, we know that there's a 5% probability of underinvestment given this assumption. So by changing your mixture, your risk capacity, you get a different set of probabilities. Change your excess cash assumption, write another derivative contract, or assume something else about your spare borrowing capacity. Well, you get a different probability. And you can actually manage then this probability by managing these components of risk capacity. So for example, you could withhold a dividend if that's part of the picture and you were planning to do so, but maybe you find it prudent not to, so as to keep more excess cash and have a lower risk. You could also issue equity preemptively to have more of a cash buffer, equity finance cash buffer, and shore up your balance sheet that way when times are still good. You probably couldn't do that after the fact, and you're in the bad scenario or very bad scenario, then it's going to be very expensive. So a lot is about being preemptive here and doing things on good terms while there's a chance. You could engage in or get more coverage from various derivatives in ways that will boost your risk capacity even more. Or you could try to secure more external funding in ways, you know, you negotiate beforehand, you try to improve your terms, etc., proactively again. So there's ways you can strengthen your risk capacity and reduce this risk. Looking at banks and financial institutions, they have some very low numbers set for the target probability of ruin, which is, you know, they want to survive by a fairly, you know, they want to have a high confidence or large confidence in that. And but here, how do we choose the optimal level of risk capacity? Well, there's no clear indicated answer here that will always work for all firms, but what we have to do is to consider the cost of not being able to execute the strategy. And the more costly we think it is, you know, formally risk is a function of probability and impact, right? So the severity of the consequences will matter, and you could formulate risk measures that, you know, incorporate both. But here we're talking about probabilities only, which is one dimension then. Therefore, you would set the probability or acceptable probability in such a way so as to reflect these costs, because you haven't formally incorporated them, but we could indirectly account for them by, you know, adjusting the probability that we find acceptable. So the worse the consequences are from these shortfalls, the lower the probability you would choose to accept, right? So if this shortfall means that you have to cut back on capex that irreversibly, you know, leads to some deterioration in competitiveness, then you would want to add more risk capacity. Whereas if you could safely postpone it, and there's some cost, but not so bad after all, you know, there's no competitor moving in or something like that, well, then maybe you can tolerate more of a probability because risk capacity is costly, right? And if you're very sensitive to the perception of your financial condition and survival prospects, you know, some firms are depend on the reputation and perceived, you know, longevity that they're going to be around. If you're one of those firms, well, you want more risk capacity as well, probably. You're going to be less inclined to. This is a cost-benefit analysis here, not so much something vague about your appetites. All right, so summing up, it's a set of financial resources, and we use it, or we benefit from it in that it absorbs cash flow shortfalls so that we can keep executing the strategy. And it consists of, risk capacity consists of excess cash and conditional sources of liquidity that are verifiably or almost to a very high extent at least available when these operating short cash flows are below cash commitments, so that there's a cash flow shortfall to absorb. So risk capacity does this and therefore helps support risk taking and secure optimal strategy execution across scenarios, including the worst case. All right, that was it. Please read more of my books. There's my webpage, riskbudgeting.z. Please like and subscribe, and have a good day.